Good afternoon, ladies and gentlemen, and thank you for joining us here today for another OIC presentation. Today's presentation is going to be on vertical spreads. I hope that everybody is doing well and is healthy during this unprecedented, crazy period that we're in. And we're happy that you're here learning about options with us today. My name is Ken Keating, and I am a senior instructor here at the OIC. Just to give you a quick background on myself, I was a former floor trader and floor specialist for 25 years. I ran off-floor prop desks. I was a risk manager as well as a derivatives analyst. So I've certainly worn many hats over the years in the options business. Currently, I work at the OIC now, helping individuals such as yourselves to better understand the risks and benefits of exchange-traded options. So before we get started, always have to start with the disclaimer. For many of you, you've seen the slide, but we always have to present it. Options do involve risks, and any individuals who are thinking about trading options should read and understand the risk disclosure document, characteristics and risks of standardized options. You can obtain a copy by visiting us at optionseducation.org, or you can call your broker and get a copy through your broker as well. In order to simplify today's computations and examples, commissions, fees, margin interest, and taxes have not been included. And lastly, any strategies discussed here today, including securities and price data, are strictly for illustrative and educational purposes and should not be construed as an endorsement, recommendation, or solicitation to buy or sell securities on behalf of the OIC. So a little bit about the OIC. The OIC, the Options Industry Council, we are the education arm of the OCC, our parent company. So the OCC is the Options Clearing Corporation. The OCC is the world's largest equity derivatives clearing organization. So we are fully funded by our parent company. We have no hidden agenda. We're only here to offer the best-in-class, free and unbiased professional options education, which we do primarily through our website, optionseducation.org. Once there, you'll find a ton of online resources, including a course load, podcast, videos, as well as past webinars. We are actually in the process of revamping our learning management system. So in the coming months, you'll see a completely reintroduced learning curriculum, which we're pretty excited about. There's going to be, it's going to be a lot more interactive. There's going to be online quizzes, tests, so lots of stuff coming down the pipe. The pride and joy of the OIC is our investor services desk, which can be reached at options@theocc.com Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options-related questions. Or we actually have an online chat service that you can access through optionseducation.org if you prefer to communicate with us that way. So a little look at the options volume since the very beginning. Options started trading in 1973 on the CBOE, the Chicago Board of Options Exchange. Originally started out with 16 issues. The very first day that options traded, I believe they traded 928 contracts. You can contrast that today where option volumes average anywhere from 15 to 18 million contracts a day. You can see by this chart, ever since 2000, over the last 20 years, option volumes have just skyrocketed. 2018 was a record year for OCC where we cleared and settled 5.2 billion contracts. 2019 was just shy of that with 4.9 billion contracts. And 2020 is already setting up to be a pretty good year in itself with the extreme volatility we've seen in the market. So as I mentioned before, on any given day, we average about 15 to 18 million contracts. In all 4 months, beginning with January, February, March, and April of this year, we've averaged anywhere from 25 to 30 million contracts a day. So certainly no lack of investors and institutions using the options market to position, hedge, and manage their risk. Okay, here's a look at the U.S. listed options exchanges. There are 5 main parent exchanges: the BOX, the CBOE, MIAX Options, NASDAQ, and the NYSE. These are the exchanges where your option orders are sent. When you buy and sell options, these are where your options are executed at. These 5 parent exchanges control 16 different sub-exchanges. We're not going to get into the differences between those sub-exchanges, but many of these parent companies offer multiple platforms, trading platforms, and essentially this is where your orders are shipped to when you execute your options. Okay, here is today's presentation outline. We are going to start with a basic of verticals. We're going to look at the basics of verticals, and we're going to talk about debit and credit verticals, the difference between those and why we'd use them. We're going to then get into strike selection and expiry. And finally, we will look at assignment risk and position management. So I do have to mention, Q&A will be conducted along the way. My colleagues Mark Benzaquin and Bill Ryan are behind the scenes as we speak, answering your questions in real time. So at the bottom of your screen, there should be a menu button where you can click Q&A, and a menu button will pop out. You can resize it to whatever size you want and ask questions during the presentation. And generally, we'll get to most of your questions today. If for whatever reason we can't get to one of your questions today, somebody on our investor services team will reach out sometime in the next 24 hours with an answer for you. To start off with, to answer one of the most frequently asked questions that we get is, can I view this webinar after the event? And the quick answer is yes, you can. The same link that you used to access the webinar today you can use to access the webinar in the future if you want to go over some of the content. If you missed something and you just want to revisit it, you can certainly revisit the webinar at your convenience. Also, make use of the resources list tab at the bottom. You can click that and pop it out and download a copy of the PDF for this presentation, or just print it out and follow along the way during the presentation. All right, so let's get into it. Let's talk about vertical spreads. So spread basics, okay? A spread essentially involves 2 or more positions, okay? Those positions can involve options. It can involve one option and stock. It can involve, the buying and selling of an option and buying and selling of stock. It can involve buying an option, selling an option. For today, we're going to be looking at vertical spreads, so we're going to be looking at buying one option, selling another. These options may have the same or different underlying asset. It may have the same or different expiration date. It may have the same or different strike prices. So one of the things, we're going to be talking about vertical spreads today, but there are other types of spreads. A horizontal or time spread would involve different expiration dates using the same strike. So maybe somebody buys a July 30 call and sells a May 30 call against it. That would be an example of a long time spread. A diagonal spread is using a different expiration date and different strikes. So maybe somebody buys a January 2021 50 call leap and sells a May 60 call against it. So different expirations, different strikes, that would be an example of a diagonal spread. But today, we're going to be looking strictly at vertical spreads. So, vertical spreads. Vertical spreads compose of either all calls and or all puts with the same expiration using different strikes. So here we have 2 vertical spreads. We have a long call spread, a debit spread, and we have a short call spread or credit spread. So in the first example, we have bought the 85 strike call and sold the 90 strike call against it. So in this case, when buying a spread, an investor will purchase the more expensive strike and sell the less expensive strike. thus incurring a debit. So the two types of debit spreads are a bull call spread, or we can take a bearish position and put on a bear put spread. Now the next spread we're looking at, the January 80-90 spread, here we have sold the 80 call and bought the higher strike 90 call against it. So now we've taken in money because the 80 call is more expensive than the 90 call. We've taken in a credit to do that, and so that's the name, a credit spread. So when selling a spread, we sold the more expensive strike, bought the less expensive strike, and the two examples of this, if we were bearish, we would sell a bear call spread, or bullish, we would sell a bull put spread, and we will get into the examples of those moving forward. So the beauty of verticals is we already know our defined maximum risk and our maximum reward going forward. So we know exactly what we're dealing with. So with a vertical debit spread, when we're paying for something, the maximum or the most that we can lose is what we pay for the spread. Pretty simple. So the maximum reward is the difference in strikes minus the premium paid. So, so we know what we can risk and we know what we can make ahead of time. In terms of a vertical credit spread, it's just the opposite. So the maximum reward that we can make in that instance is the amount that we took in, or the credit that we received for selling that spread, and the maximum risk is the difference in strikes minus the credit that we took in when we put on that spread. So once again, very defined in terms of what we can make and what we can lose. And this is only another qualifier. This is only in terms of as long as we have the spread on. So if we were to exercise one of our long positions or get assigned on one of our short positions, that may change the risk reward parameters of that position. We'll get into that a little later, but just know that these risk reward profiles of vertical spreads only really apply if spread stays a spread. Okay, well, let's take a look at, jump into looking at debit spreads. So the first spread we're going to look at is, as the name implies, a bull call spread. So obviously in this case, we're looking to benefit from a rising stock price during the lifetime of the option. So this is a type of vertical spread. It contains two calls with the same expiration, but different strikes. Obviously, we want the shares to go higher or we'll profit. So we're buying the lower strike call, selling the more expensive strike call. So we're incurring a debit to do that. And once again, our maximum risk in this position is what we paid for the spread. The benefit of the short call that we sold helps to reduce the cost of the strike that we bought below. Okay, so it lowers the cost of our trade, but at the same time it caps our upside. So we can't sell options, if we just owned the one call, we would have unlimited upside, but we would also incur all that loss if, the debit that we paid if the stock went south. So to hedge or reduce our risk, we're going to sell another call against it, thus putting on a bull call spread, more inexpensive way to take a directional bullish opinion on an issue, on a stock. The cost of the short call maximizes our upside potential, however. All right, so we're going to look at a scenario here. So we have an investor, and he's bullish on a fictitious soft drink company, BUBL. We could commit, we could buy 100 shares of this company, but it would cost us $11,500, okay? So instead of forking out all that capital and having 100 shares of stock, we decide that we are going to establish a bull call spread instead. So we look out on our options chain, and we see that we can buy the 45-day out 115 call and at the same time sell the 120 call against it. Okay, so we paid $2 for the 115 call. We sold the 45-day call at 70 cents, incurring a net debit of $1.30 or 130 per spread. That's the most we can lose on this position. So buying the 115 call gives us upside. Selling the 120 call caps our risk. So the most we can lose on this position is $1.30 or 130 per contract. So here's our spread again. We own it for $1.30. Our maximum gain, okay, we take our strike prices, the difference in strike price, 120 minus 115, that gets you to $5. We minus the $1.30 that we paid for the spread, that's $3.70. We multiply that by 100 because every option contract is on 100 shares. That leaves us with a maximum gain if the stock goes above 120 by expiration of $370 per contract. The maximum risk, as we talked about earlier, is what we paid for the spread, the 130, and our break even. If at expiration the stock is exactly at 116.30 at expiration, we will have neither lost money nor made money, okay? Because the 115 call will have an intrinsic value of $1.30 with the stock trading 116 at expiration. So something to keep in mind once we get to expiration. You might not want to carry this position. You just might want to sell out of it, unless, of course, you do want to exercise that call and be long this stock. All right, so now let's take a look at the same spread, but now in graphic form. So once again, if shares finish above 120, and we're looking at expiration with the shares above 120, both calls are in the money, and our maximum profit of $3.70 is achieved. Okay, if the stock were above, say it was trading 125, we'd exercise our 115 calls, we'd be assigned on our 120 calls, thus making $5 on our spread. Subtract the 130 that we paid, we collect $370 per contract. Now, if shares finish between 115 and 120, in this case, at expiration, the 115 call that we're long, we would exercise. The short call that the 120 call would expire worthless, and our P&L would be determined by wherever we could sell the long stock position. Now granted, you don't have to exercise at expiration. You could certainly, on expiration, just sell this call out, and you wouldn't have the stock risk overnight. So know that, come expiration, you certainly don't have to exercise your contract. You could just sell it out into the marketplace and be done with the position as well. And if shares finish below 115, both calls would expire worthless. This is the worst case scenario, but then we know that going into it, our maximum risk is the $1.30 we paid, and that's where we would achieve our maximum loss is below 115. So once again, our break even is at 116.30. So anywhere between 115 and 116.30, our 115 call would be worth something. We'd lose some value, but we could recoup some of that between 115 and 116.30. Our losses would be, wherever the stock closed at, whatever the intrinsic value of that option is, would be what the option would be worth. Okay, now let's take another look at a debit spread. Now we're going to take the opposite side of the coin. We're going to put on a bear put spread. So now instead of being bullish, we are bearish. And our forecast is we're looking for shares to decline. So how can we play this? We could buy a put, we could sell stock short, or we could sell calls naked. Well, certainly selling stock short and selling naked calls involves considerable amounts of risk. So we're going to look to purchase a put to play the downside. But, anytime we purchase a put, our risk is what we pay, the premium that we paid for that put. So instead of, forking out all that money for that put, we're going to establish a bear put spread, which is going to offset the cost of the put that we buy. So in this case, we're going to buy the higher strike put. We're going to sell the lower strike put, and we are going to put on a bear put spread. So once again, we are limiting the amount of debit that we're forking out for the spread. We're still taking a bearish position on the stock, but we are capping our maximum gain at the short strike of the put that we sell. So now we have a scenario where we have a fictitious company, DOLR, a hypothetical financial services company. Stock is trading around 54, and our investor is looking to establish a bearish position in this stock. So once again, we can sell stock short, we can purchase a put, but the broker says, well, instead of doing either of those, why don't you just put on a bear put spread? So once again, selling 100 shares, we have unlimited risk to the upside if shares rally and may require significant margin. If we buy a put, our risk is limited to the premium that we paid, but putting on a bear put spread, by buying one option and selling another, we're somewhat hedging ourselves. Okay, we're still outlaying money to do that, but we are limiting our debit, and at the same time, we are capping our risk to the downside. It offsets the cost of the trade, but we are capping the maximum amount that we can make on the spread. So just like the bull call spread, the bear put spread, in this case, where you look at our options chain, and we can buy the 60-day 52.5 puts. Remember, the stock is trading at 54. We can buy those puts for $1.65. At the same time, we can sell the 50 puts for 65 cents for a net debit of $1, which is $100 per spread. And we decide that we're maybe a little more bearish, so we decide to buy 5 spreads instead of 1. So our maximum risk in this position is the $500 that we paid for the 5 spreads right there. What is our maximum gain? Our maximum gain is the difference in strike, 52.5 minus 50, so 250 minus the $1 we paid. So our maximum gain is $1.50 times 5, or 750 per contract. I'm sorry, 750 for the 5 contracts that we have, because remember we did this 5 times. So our maximum gain is 150 per spread, times 5 is $750. So that's our maximum gain. Our break even is the higher strike, the 52.5 put, minus the $1 that we paid, or 51.5 is our break even on the spread. So once again, looking at it in graphic form, as you can see, it's just the mere opposite of what the bull call spread is, the bear put spread. Now we're looking for shares to go down to make money. Our break even there is at 51.5. Below 50, our spread achieves its maximum value of $1.50, or $750 per contract. If shares finish between 50 and 52.5, the long put would get exercised and the short put would expire worthless, and our P&L would be determined by wherever we buy back the shares. Now granted, you don't have to exercise, like I mentioned earlier. You would most likely choose to trade out of this before these options expired, but you're certainly free to exercise the put if you want and carry the short stock position. If the shares finish above 52.5, both puts expire worthless, and the maximum loss of $500 per contract would happen above 52.5. So as you can see, obviously we want the stock to be below 50, at 50 or below at expiration, and anywhere between 51.5 and 50, we were still making money. All right, so now we're going to take a look at credit spreads, just the opposite. So credit spreads, forecast and motivation for a credit spread. Anytime you put on an options position, whether it's a debit spread, credit spread, a butterfly, a straddle, a strangle, you have 2 things you have to always consider. It's your forecast and your motivation. So in the case of a credit spread, in the case of a bear call spread, okay, our motivation our forecast is that we are neutral on a stock and moderately bearish. And we're also looking to increase, bring in a little income. In terms of the bull put spread, okay, same idea, but just the opposite. We want shares to either sit and be quiet and be neutral, or moderately bullish. We want the stock to go higher, and we're also looking to bring in a little income. So what's the commonality? Well, we're looking for a range-bound stock or to get our direction right, and at the same time, we're looking to bring in a little income. So we're going to look at the first credit spread, a bear call spread. So now we're going to take a bearish position, and instead of buying a debit put spread, we're going to sell a bear call spread. So obviously we're looking for shares to decline or stay flat. The motivation is also, again, for income. So, to be short, we could always sell calls naked. We could sell stock naked, but there's obvious risks in doing that. By putting on a bear call spread, you are defining your risk. So selling naked calls, selling stock short, yes, if the stock goes your way, you're going to make money. But if the stock rips and goes against you, you have theoretical unlimited upside risk by doing so. So to offset that, we are going to look at instead we're going to sell a lower strike call and purchase a higher strike out of the money call against it. Okay, so same thing. We're looking for shares to go down. And by doing so, now we are taking in a credit. Somebody's paying us a credit to put on this position. So we're selling the lower strike call, buying the higher strike call. And here is the bear call spread in review. So just looking at it, as mentioned earlier, we're selling the lower strike, buying the higher strike. The maximum gain is equal to the credit that we take in from selling that spread. So that doesn't change. That's the most that we can make on the spread till this option expires. That's the most we can make. The maximum loss that we could incur is the difference between the strikes of the two options minus the credit that we took in. That's our maximum loss. Our break even on a bear call spread is the short strike call plus the net credit that we receive. That's our break even. Once again, our forecast, neutral to moderately bearish. Volatility. Okay, this is an interesting idea here. So when you do a bear call spread, you are contract neutral, okay, because you're long one contract, short another, okay? So you're contract neutral, but because in this case you are short the more premium sensitive option and long the out of the money less premium sensitive option, if volatility goes up, we have an increase in implied volatility. In the interim, that could have an overall but slightly negative impact on your position. So your position could fluctuate depending on how volatility moves in the interim. That's not going to change your maximum gain or loss because you've already established that by selling the spread. That's not going to change, but there might be some noise depending on what volatility does in the interim. Time decay, or theta, this is positive. So when we do a bear call spread, theta is our friend because every day if the stock doesn't move and just sits, those options are both going to decay every single day. And the more premium sensitive option is going to decay more rapidly or more so than the out of the money call that we're long. So it's going to have a net positive effect on our position. So time decay is our friend. And lastly, assignment risk. Anytime you are short options, you always have assignment risk. That is with American style options. So options can be exercised by the long holder at any time for any reason. Generally speaking, we're going to get into why somebody would exercise early later on in the presentation, but just know that if you are short options, you always have assignment risk. So in the case of a short, this bear call spread, if our short call is assigned and our long call expires worthless or unexercised at expiration, we will wake up on Monday morning and we'll wake up with a short stock position. Okay, so you do have market exposure if you carry this to expiration and your short call gets exercised and your long call expires worthless. So, and this is another one of those reasons why a lot of traders will choose to trade out of these positions rather than carry them exactly all the way through expiration. All right, so let's look at the bear call spread in review. So here we have put on the 90.95 bear call spread. We have sold the 90 call for $3.50. To protect ourselves in case the stock moves against us, we have purchased the 95 call above it for $1.80. And so we've taken in a net credit of $1.70. So that is the most we can make on this position. So obviously we want it's a bear call spread, so we want the stock to go south. With the stock below 90 at expiration, we would keep the net credit that we took in, the $1.70. And obviously our risk is to the upside. If the stock moved against us and went higher, our risk is at 95 or higher. So at 95 or higher, that spread would be worth $5, and our maximum risk is the $5 minus the $1.70 or $3.30 per contract. So in this case, we are risking $3.30 to make $1.70 in this particular case. Our break even is at 91.70, so that is our break even. So ideally, we want the stock to finish anywhere from at 90 or below at expiration. All right, so now let's take a look at just the opposite, the bull put spread. So now we want to take a bullish position on the security, and instead of buying a debit call spread, we're going to sell a bull put spread. So our expectation, our forecast is we expect the shares to be moderately, we're neutral to moderately bullish on the shares, and our motivation is to create a little income. So how could we do that? Well, we could sell puts, just naked puts, or we could buy stock. Well, both are very risky. So when we sell naked puts, we have unlimited risk to the downside. Buying shares is always capital intensive and involves risk because our risk is, once again, to the downside if the shares plummet. So now we're going to take a bullish position by selling a put spread. So we're going to sell a higher strike put, and to offset that risk, we are going to purchase a lower strike put against it for protection and limit our downside. So once again, by doing that, by selling the higher strike put and buying the lower strike put, we've taken a bullish position using puts and taken in a credit to do that. So once again, selling the higher strike put, buying the lower strike put, our maximum gain always equal to the net credit that we took in. Our maximum loss is the difference in strikes minus the net credit that we took in. Our break even on this position is the short strike put minus the net credit received. Okay, that is our break even. Once again, our forecast, we are neutral to moderately bullish. Okay, obviously we want the shares to go higher, but if they just sit and do nothing, we're happy too, because we're making that time decay because we're short the more premium heavy option. So time decay is our friend. And once again, just like the bear call spread, volatility has a slightly overall negative impact for us. If it goes up, could impact our position in the interim, but once again, it doesn't change the fact that our maximum gain is always going to be equal to the net credit that we took in, and our max loss is always going to be equal to the difference in strike minus that credit that we took in. And lastly, assignment risk. If at expiration that we decide that that short put that we sold is in the money and our long put is out of the money and we do nothing, we will surely be assigned on our short put, and on Monday morning we'll wake up and we will be long stock and we will carry that overnight risk. So once again, we'll have market exposure if we get assigned on our short strike, and to alleviate that, most traders will choose to just close out the spread before that would happen, on or before expiration. So here is the bull put spread in review. Once again, we are going to sell an 85-80 put spread. So we look at our options chain and we see that we can sell the 85 put in this example for $2.05. We can buy the 80 put below it for 70 cents, thus taking in a credit for $1.35 or 135 per spread. So the max profit occurs when both puts expire out of the money or worthless. So with the stock above at 85 or above at expiration, we would keep that $1.35 credit. That would be ours to keep. Once again, the maximum loss on this position would be the difference in strike, $5 minus the $1.35 that we took in. $3.65 would be our net risk per spread, or $365, which occurs with the shares below 80 at expiration, at 80 or below on expiration. Our break even in this case is right at 83.65. All right, so let's take a look at strikes and expiry, so which expirations to pick. So anytime you are selling in the money strikes, okay, your reward is greater because you're taking in a larger amount of premium, but you also have a greater likelihood of assignment. So, your forecast and timing is key. That's why we always say, traders have two things that you need to consider before you put on any trade: your forecast and your motivation. So, depending on how much premium you're getting for the options or how much premium you're paying for the option will determine which months you're going to pick, what strikes you're going to pick, what everybody's different. Everybody's opinion on a stock is different. So it all is going to be individualized in terms of your own risk tolerance, how wide of a spread you want. It doesn't necessarily have to be a $5 wide spread. It could be a $10 wide spread, $20 wide spread, but keep in mind that your risk and reward is still the same. When you buy a debit spread, your risk is how much you pay for the spread. When you sell a credit spread, the maximum you can make is whatever credit you take in when you sell that spread. For debit spreads, the short strike is the boundary for your spread, and it lowers the cost of that spread. For puts, when you sell that put, it's also the hedge as well. For a debit put spread, it's lowering the cost of the spread. In the terms of a credit spread, the long strike is purchased for protection in both cases. So for a bear call spread, the long strike is purchased in case we get an adverse move to protect us. And in the case of a put spread, likewise on the downside, that's why the lower strike is bought for in the bull put spread against the higher strike that is sold. All right, another thing to consider is strike and expiration is short-term versus long-term. And once again, this gets to the idea that everybody's individual, everybody's different, everybody has different risk tolerances, and so this is going to be different depending on who you are. It's going to be different for everybody. So when you're selling credit spreads, time decay obviously is working in your favor for option sellers. Now generally, the sweet spot for options, to sell options, is anywhere from 30 to 45 days left to expiration. That's where option sellers like to target, and that's because options don't decay in a linear fashion. So, the further out you go, the more expensive options are, but they don't decay as much. So further dated options don't decay as much as shorter dated options. Once we get to about 35 to 45 days left to expiration, those options decay at a more exponential rate. Okay, it's not linear. So that's why option sellers like to target options with 35 to 45 days left to expiration. So in this case, time is money. Longer expirations involve higher premiums, but it also entails higher risk. So one of the differences between longer dated and shorter dated options, while shorter dated options will decay faster than longer dated options are more vega sensitive. So in other words, longer dated options have what's known as vega risk, and they're more vega weighted. So if vega or implied volatility goes up or down, your longer dated options are going to be affected to a greater degree than your shorter dated options. So certainly different little risks and rewards with longer dated and shorter dated options. The end game obviously for option sellers is for those options to expire out of the money and worthless. That goes without saying, but certainly, which strikes and expirations you pick will be based on a lot of different factors. Certainly, implied volatility is one reason that somebody would consider doing one spread versus another. And one thing I wanted to mention, so getting back to earlier when we were talking about debit and credit spread. So, why would I pick a bullish position, do a debit call spread, or why would I choose to do a bear put spread? Okay, so they're both bullish, but why would I pay for a spread? Why wouldn't I just sell a spread as opposed to buying a spread? So why wouldn't I just take in a credit every time to take a bullish position or a bearish position? Well, the reason why is because depending on where implied volatility is, that is going to dictate whether you're going to do certain strategies. And generally, when implied volatility or the price of options is really low, traders generally like to, that's when buying options makes sense. So that's when you might consider doing debit spreads when, implied volatility is low. We're not going to get into implied volatility today, but I can tell you one thing. I emphasize for anybody who's trading options to, get a firmer grasp of implied volatility. You can certainly go to our OIC page, our homepage, or our YouTube page, and look at videos on implied volatility. But it's the most misunderstood and crucial aspect of options trading is implied volatility. So, as I said, when implied volatility or option prices are low, traders will generally like to put on debit spreads. And on the flip side, when implied volatility is high, like we've witnessed throughout, from January or February all the way to the present, where prices are generally higher, that's when you might consider putting on a credit spread, because now it's a way to sell high implied volatility, but you can also take a directional or neutral bet by doing so. So, certainly there's certainly, you can make money in any type of market, but, not all option positions work under all conditions. Okay, so some are better in high vol environments, some are better in low vol environments. Okay, so let's take a look. We mentioned that we were going to talk about assignment risk. So anytime we're short options, we assume early assignment risk when we're talking about American style options. So generally, when somebody exercises early, most likely in the case of a call, somebody would exercise a call early to capture a dividend. And generally this occurs on the day prior to the ex-dividend date. So one thing I'm going to mention is there's a formula, and you should probably all memorize it, but if you're short a call and let's say a stock is going ex-dividend tomorrow. Okay, let's look at this. Let's assume like you sold the 45-50 call spread. Okay, so you're short the 45 call and you're long the 50 call. And the stock goes to 50. It's sitting at 50. And the stock is going ex-dividend tomorrow for 50 cents. If your 45 level call if the time premium left in that call is less than the amount of the dividend, then that option is a strong candidate to be exercised early for the dividend. So, you know, a 45 call with the stock trading at 50 is going to have an intrinsic value of $5. Well, that call might be trading for $5.20 in the market. That extra 20 cents, that's the extrinsic value or time premium. So that 20 cents in this case is less than the amount of the dividend. In that case, that call is a strong candidate to be exercised early. If you're short that call spread before that ex-dividend date, you might consider closing that spread out or rolling it to a higher position, a higher short call spread to alleviate the assignment risk, because surely that call will get assigned if you do nothing. So just something to keep in mind. Generally, people who exercise early are doing it in terms of calls are doing it for a dividend. So on the flip side, you know, why would somebody exercise a put early? Well, a put would be exercised early. Usually it's during periods of high interest rates. Somebody would exercise a deep put because the short interest they would receive by being short the stock would, if that exceeds the amount of time premium left in that option, then that put is a candidate for early exercise. But now with interest rates at practically zero, generally speaking, you wouldn't see a lot of puts being exercised early for the interest. Not to say it couldn't happen, but a lot lower right now. The chance of that happening a lot lower. So when, you know, if you have a credit spread on, you can certainly use the long option to cover. If you do get assigned, you can certainly use the long option to cover your short stock obligation. But, you know, if you get assigned, if you're long the 50 call and you get assigned on the 45 call, you could have 1 day of exposure. You know, you're obviously your risk to the upside is still capped, but just know that you would have that 1 day of short stock exposure. You'd have short 100 shares, long and out of the money call against it. Pin risk, something to consider at expiration. So let's say we're short that 45-50 call spread, and the stock is right at our sweet spot. It goes right to 45. You know, we sold the spread for $1.30. We're dancing because now we're going to pocket all that premium, and we choose to do nothing. Well, in theory, both options are worthless. Okay. In reality, that you're still on the hook for assignment risk if somebody chooses to exercise that call. So if at expiration you think that both options are going to expire worthless, you could very well wake up on Monday morning and face that somebody exercised that call, and now you would have a short stock position on Monday morning. If the market gapped in a big way on Monday morning, you would have that short stock exposure. So once again, most traders choosing to close out positions ahead of expiration rather than let their options expire worthless. So I know that there's a rumor out there, it's a false rumor, that 90% of all options expire worthless, and this is certainly not the case. OCC does some statistics every year, and generally around 70% of all option contracts are traded out of before, they're closed before, on or before expiration. So very few contracts make it to actually exercise. So the majority of traders do close out positions on or before expiration. All right, so lastly, what do we do managing the position? Okay, so if we have one of these positions on and it moves against us, what can we do? So we have the bear call spread, okay? We sold the lower strike call, bought the higher strike call. The market's moving against us, maybe volatility is moving against us. Sure, we know our complete risk and reward. We know the most we can make on that spread is the credit that we took in. The most we can lose is the difference in strike less the credit we took in. But maybe we want to be a little more proactive. Maybe we see where our forecast changes, and then instead of being bearish, now some news comes out and we're bullish. So now, you know, we can either close the spread entirely, you know, take a slight loss, or we could roll that position up to a higher strike, maybe roll to the 50-55 spread, or 55-60 spread, or 55-65 spread. You know, all different ways of managing this risk. You know, certainly that's going to be different for every individual. Everybody's got different risk tolerance, but you know, being proactive with options is crucial, because options are living, breathing things, and these aren't set it and forget it strategies. These are things that need to be monitored on a daily basis, and it really it's important that you stay on top of these positions, because there's a lot of factors and a lot of things that affects them. Same thing with the bull put spread. You know, we expected the market to go up, and now it's going down. Maybe volatility is increasing. What can we do? Well, we can roll down, or we can roll down and out. So, or we could just close the position entirely and, you know, live to fight another day. That's certainly a choice that we have. So certainly position management is something that you need to consider, and you know, that's going to differ from individual to individual. All right, so that is the end of our presentation. For more information regarding this presentation or any other questions you might have, you can certainly visit our website, optionseducation.org. Once again, you can reach out to our Investor Services Desk Monday through Friday from 8 a.m. to 4 p.m. Central Standard Time with any and all of your options-related questions. Just email us at options@theocc.com. And certainly check out our OIC YouTube channel, because we have archived many of our past webinars there. So you can go there, do a search for any topic you want to study, whether it's implied volatility or credit spreads, debit spreads, straddles, strangles, butterflies, whatever it is. Certainly you have access to that resource, and the best part about it is it's free. So once again, I thank you for attending today. I do want to mention that this is our last webinar for the month of May. The next webinar we'll be presenting will be on June 17th. In fact, I'm going to be the one presenting that one, and that one is going to be on the directional butterfly. So what we're going to do is we're going to build on the idea of the credit and debit spreads that we learned about today. So we're going to combine a debit spread and a credit spread, and we're going to combine them and make a completely new strategy, which is called the butterfly. And that's something we're going to explore on June 17th. So that's it for the presentation. Thank you again for attending. I certainly encourage you to fill out our survey at the end of the presentation. We do read each and every one of your comments, and it certainly shapes our program going forward. So we appreciate your support, and stay safe, and we look forward to seeing you at the next event. Goodbye, everyone.